$50,000 invested into high quality dividend growth ETFs that compound over time is truthfully worth much more than $50,000 later on in the future. And in this video, I'm going to go over multiple different examples and show you the exact math on how a $50,000 investment is literally halfway to $1 million invested later on. Now, we're going to go over some super important topics in this video, so make sure to drop a like down below, stick around, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So the first thing that we have to talk about and make sure we're all on the same page, we're going to be talking about the power of compound interest and how it changes everything, especially if you buy into the right investment vehicles. Now, it says right here, compound interest accelerates the growth of your savings and investments over time. Conversely, it also expands the debt balances you are owed over time. It then says, what is compound interest? With compound interest, you're not just earning interest on your principal balance. So you're not just earning interest on the $50,000 for this video's example that you invested. Your interest later on is also going to earn interest, which after that, guess what happens? That interest also earns interest. So let's say you have $1,000 in your savings account, or in this case, just say you have $1,000 in a dividend growth portfolio. Now, let's say that you earn a 5% yield in dividends off that. Now, in 1 year off the $1,000, because of the yield, you earn $50, but the new balance being $10.50, you would earn 5% on that, which gives you a new raise of $52.50 the next year. Now, even though year over year, you're only earning $2.50 more, obviously, as you can imagine, if you invest more money than just $1,000, this is going to compound much quicker, and this is where the dividend snowball name comes from. So now that we're familiar with the power of compound interest, we also need to know and understand and be on the same page of this other very important metric. And for this, we're talking about dividend growth rate. Now, it says right here in Investopedia, dividend growth rate, the annualized percentage rate of growth of a particular stock's dividend or ETF's dividend over time. Now, dividend growth rate is super simple. This is exactly going to be how it works if a stock or ETF pays out a certain amount year over year annualized. So let's say for year one, $1 was paid. Year number two, $1.05 was paid. Year number three, $1.07 was paid. Year number four, $1.11, and year number five, $1.15. So from year one, the $1 dividend payment is now as high as $1.15, which means the dividend has grown over time. Or as far as a percentage goes, year number 1 to 2 is 5%, 2 to 3, because it was a little bit smaller, was 1.9%. Then year number 3 to 4, we have 3.74%, and then 4 to 5, we have 3.6%. So it's probably kind of obvious that you're going to want to look to invest into different stocks and ETFs that not only are going to go up over time, but also are going to pay you dividends and pay you more and more in dividends long term to really unlock the magic of compound interest and grow your portfolio substantially. And like I said, exactly how $50,000 is not halfway to $100,000, but $50,000 is literally halfway to $1 million. So now you're probably saying, well, great, I understand the power of compound interest. I understand dividend growth rate. Yes, you want to invest into things that pay you over time, but also pay you more and more over time, because as they pay you more and more over time, and as you reinvest, the power of compound interest is going to grow things significantly. But now you might be asking, well, what are some investment vehicles that have done this historically? And although there are tons of them out there, there's literally tons. Go through my channel and I talk about them every single day. But one of my favorite of all time is specifically the Schwab US Dividend Equity ETF, or ticker symbol SCHD, which I'm sure you've either heard about or hold in your portfolio as of right now. Now, the great thing about SCHD specifically, and why we're going to use this in this video's example to show you how $50,000 is halfway to $1 million, SCHD offers a 3.37% trailing 12-month dividend yield. And depending on where you bought SCHD as of recently, it's somewhere close to 3.5%. So for this video's sake, let's go with 3.5%. So a 3.5% yield, that means that technically for every single $100 that you invest into SCHD every single year as far as dividends go, that you hold on to a single share, you're going to get paid somewhere around $3, $3.50 for every single share that you own. Now, even though that sounds great, it gets even better. Over time, as you can see right here, SCHD has paid more and more in dividends to shareholders, more or less every single year since its ETF's inception back in 2011. Or to be even more specific, over the last years, SCHD has paid investors roughly 10% more or less every single year in dividend income, which means, for a simple example, again, if you were paid $1 one year, you would then be paid theoretically $1.10 the next year, etc., etc. Now, for this, there's only one last thing to do, and this is to show you the exact math on how $50,000 invested is halfway to $1 million. And keep in mind, all these numbers can change in the future. We're going off of historical performance, which doesn't indicate future performance, but just to give you an idea of how easy this can be potentially. Now let's say a $50,000 investment into something like SCHD. Like I also said, there's tons of other high quality ETFs out there, but SCHD is just an easy example to use. So SCHD is yielding around 3.5%. We just showed that SCHD's dividend amount increase on a lot of years has been around 9 or 10%. So let's go with 9. A $1 contribution annually from there, which means more or less you're not contributing anything else. You're just investing $50,000, which for this example specifically, I'm trying to simulate a 25 or 30-year-old investor that has around $50,000 as far as a portfolio goes. Invest in SCHD to show you how easy it is from here to get to $1 million. So we have the 50K, we have the 3.5% annual initial starting dividend, we have the 9% dividend increase, we have 3% annual share price appreciation, and this of course is for 30 years. So if you're currently 25, this will make you 55. If you're currently 30 or 31 like me, this will make you 61 years old. So again, as far as years go, this would be halfway. If in 30 years you got to 50,000 as a starting principal, this is going to be the other half, 30 more years to get to 60. Dividend reinvestment or DRIP is also going to be turned on, of course, to really allow the power of compounding to do its thing. So here's exactly where and how the magic happens. The first year, this investor's $50,000 would earn around $17.73 in dividends. But then with those internal dividend increases, by year number 2, this portfolio is already making almost $2,000 per dividends, which is substantial just over 1 year. And again, this is not even adding any more money to the portfolio, which would only make things grow a lot faster. So by 10 years in, this portfolio would be worth around $90,000, with around $5,400 per year in dividends. Now again, as those dividends are being reinvested into the portfolio, theoretically buying more and more shares of SCHD, and of course those internal dividends getting larger and larger every single year, by 15 years in, the portfolio would be worth $137,000 and around $11,000 annual dividend income at this point. By 20 years in, this portfolio would now be at $228,000 and $25,000 per year in dividends. So it only took 20 years to basically quadruple plus the portfolio. That started with $50,000 and a portfolio that you did not contribute to since then. Now I promise that as a 30-year-old that saved up $50,000, they'd be halfway to $1 million. So if a 30-year-old invested into SCHD, just going off of these numbers, which again, we don't know what they're going to look like in the future, but just to give you an idea of the power of compound interest. By 30 years in, this portfolio could be worth potentially $900,000 plus, earning $178,000 per year in dividends with an after drip value of $1,073,000 and some change. So either way, it just goes to show that over time, even with a relatively small amount of money, not saying that $50,000 is small necessarily, just saying that compared to $1 million, it feels like you are much, much further off. But with a $50,000 investment, a portfolio could potentially have an ending balance of $1.1 million if a portfolio had an average annual return of around 10 or 11% and was reinvested every single year. If you're currently working to build out a long-term portfolio that's going to look like something like this long into the future, which stocks or ETFs are you most bullish on over the next 30 years? Drop them in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.